Good morning, all. We're just going to give it probably 60 seconds or so to allow people to join, and then we'll get started with this morning's webinar. Can still see some people joining, so we'll give it just another 30 seconds. Okay, let's get started. So good morning, everyone. Thanks for joining us today to discuss the latest updates following the PRA's recent announcement on the delay to Basel 3.1 here in the UK. My name's Ronan. I am a risk and regulatory specialist here at Swade, and I'll be moderating this discussion today. So over the next hour, we're going to be covering some key questions around Basel 3.1, including the challenges that financial institutions are facing in allocating resources, hiring specialists, managing reg change projects, and the like. The alignment of the SDDT and Basel 3.1 and the impact that that has on smaller firms. How banks are navigating the standardized versus IRB approaches, and the impact of the delay on firms planning to implement new IRB models before 2027. The cross-jurisdictional challenges for banks, global banks, and how the PRA's delay might also influence regulatory frameworks in the EU and the US. And finally, the technical challenges firms are facing from data management to interpretations of the new regulatory landscape. To help us along in that discussion, I have the pleasure of being joined today by Simon Hills, Stephen Hall, and Dominic Whittingham. So Simon leads the Prudential Capital and Risk team at UK Finance, which focuses on influencing the implementation reforms to capital and liquidity requirements in the UK. He leads UK Finance's work on the Senior Managers and Certification Regime, the SMCR, which seeks to improve bank-wide governance and culture, and has extensive knowledge of prudential regulatory architecture. Simon, thank you for joining.
Pleasure.
Stephen is a partner in the risk practice of KPMG Financial Risk Management Department, specializing in credits and counterparty risk management and prudential capital regulation and advisory work for banks and financial institutions. Stephen has 19 years experience of assurance, risk and regulatory advisory work, with 15 years of experience delivering a range of advisory projects. He leads KPMG's work on credit risk, counterparty credit risk, capital management, Basel II, Basel III activities, and IFRS 9 ECL risk activities in the UK. Stephen, thank you so much for joining.
Thank you.
And Dominic, last but not least, is the head of the capital management team at Santander UK, responsible for capital planning of the UK group and the operation of governance arrangements for capital and associated communications with regulators. In addition, he's responsible for providing advice on regulatory capital matters to a range of Santander UK departments and supports the development of Santander UK and Santander Group responses to capital-related regulatory proposals. Previously at Santander UK, which was formerly Abbey National, Dominic was responsible for implementation of CRR and CRD4 and production of the associated disclosures requirements for Santander UK. And he's held roles covering portfolio credit risk modeling, economic capital modeling, trading book market risk capital, derivatives market risk, and internal audit. So Dominic, also thank you very much for joining.
Thank you.
Just one bit of housekeeping before we get started. So this session will include a live Q&A at the end and some interactive polls throughout. So we do encourage all of those online to participate, share their insights and engage with our panelists. Additionally, we are offering a handful of free 30-minute consultations with our experts here at Swade to discuss any challenges that your firms might be experiencing in your own Basel 3.1 implementation journeys. You can find a link for those sessions in the chat, and just to be aware, that is on a first come, first served basis. All right, so now that that is all out of the way, we can kick things off. Obviously, top of the mind here is the recent announcement from the PRA about the delay to Basel 3.1 implementation to the 1st of January 2027. Simon, can I get your thoughts on the delay there?
Yeah, sure. Thanks, Ronan. So we'd been sort of quietly chatting with people behind the scenes about, well, wouldn't it make sense for a delay? We've not got the first idea, frankly, what's happening in the United States. I talked to my opposite number at the American Banking Association. He hasn't got the first clue what's going on. So given that, you know, the UK is a preeminent international market, it made sense to delay, and that was the message we were giving. When the announcement came out, what was it, 3-4 weeks ago now? You know, I think we were all parsing the statement, trying to pick it apart, understand, you know, what the motivation was. I think the motivation was driven probably primarily by the Finance Ministry, by HM Treasury, but the PRA saw the sense in it as well. But, you know, would there be another delay? Why did they delay not delay just the trading book? Because that's, I think, where most of the sensitivities lie. I think it's quite clear, as things stand at the moment, Ron, that there won't be another delay, as I understand it, although I have to check this. The wider team that was working on the Basel 3.1 legislation has been disbanded. So what we are going to get when we get the final rule book, which I think will be sooner rather than later, is what you're going to be working with to implement Basel 3.1 by the beginning of 2027. So I don't think there are going to be any changes to that at all. It makes sense. I think this is, as I say, nudged along by HMT, and it also made sense to delay the whole package, not just the fundamental review of the trading book elements of it. You know, if we look at the pickle that the EU has got itself into in relation to delaying the FRTB bit, the market risk bit of the package, I just don't think it made any sense to pile further burdens on firms of, you know, trying to work out the crossovers between FRTB and the rest of it, output floor and that sort of thing. So welcome, probably nudged by HM Treasury, and you know, we're going to go on and talk later on what this means for people's implementation. But I think, you know, we can be pretty sure that the near final draft rule book is what we're going to have to implement when it's finally released.
Yeah, thanks, Simon. I mean, you touched on it there, but the regulatory divergence with other jurisdictions, because obviously introduced complications. But for now, I think you know, banks have more time for their model redevelopment and capital planning and things like that. So Dominic, over to yourself for this one. What are the implications for the new timelines regarding firms looking to implement, you know, new IRB models between now and 1st of Jan 2027?
Well, I suppose obviously the 1 year delay means that if banks are looking to implement models in 2026, they will have to be under current rules rather than the Basel 3.1 rules. And obviously that means in reality that the input and output floors will not be applied to the models. And also there are some changes to particularly exposure at default between the current standards and Basel 3.1 standards. So it will be necessary to implement EAD modeling consistent with the current rules, which will then need a small degree potentially of modification in 2027 when the new rules are applied. For firms looking to apply with Basel 3.1 models, it's then a case of maybe reversing on the EAD and backing out the input and output floors if they want to implement ahead in 2026. At least my understanding of the situation is the PRA are kind of being rather pragmatic when it comes to this. Obviously, it was the delay was announced at relatively short notice. So obviously, particularly in our case, it's really a case of talking to the PRA to understanding what the new kind of implementation path would be with the regulator.
Thanks very much for that, Dominic. And talking, Simon, back to yourself for this one, looking at the SDDT and the alignment now of SDDT with Basel 3.1. Obviously, the ICR was introduced as a kind of transition into Basel 3.1 to help cushion some of those capital impacts. What impact do you think that is going to have now that those dates are aligned, particularly on smaller firms?
Yeah, should we just mention, Ronan, that there's a poll live at the moment, so people might want to fill that in as we chat. So there was some discussion amongst members about, well, because you remember that the ICR was going to run for an extra year now that the implementation of Basel 3.1 has been delayed by a year. Those dates are now coincident. I don't think there's any appetite to delay SDDT implementation or choices until the beginning of 2028. So that's where you are at the moment. We responded to the PRA's consultation paper on capital aspects of SDDT, and we raised significant concerns about the cost of operational risk capital, the buffer, the sort of now combined buffer. Just feeling those have been set rather too high. And of course, if you lay that alongside the removal of the refined approach, which philosophically I can understand, the refined approach, if you remember, allows firms to apply for an offset of unduly conservative Pillar 1 requirements against their Pillar 2 add-on. Now, Pillar 1 has been fixed, and the risk weights more accurately reflect the actual risk. There's in the PRA's view no need anymore for that Pillar 2A offset. That's going to have a big impact on some banks and building societies. So we've opposed that, and I don't know where we're going to get to on that. I suspect, because as I say, sort of theoretically, it's the right thing to do. That refined approach will be removed. I don't know, Stephen, if you've been talking to some of your smaller firms about the impact of the refined approach, some of your clients.
Yeah, I mean, I think that is, as you say, one of the big challenges. Just on the other couple of points you said on timing, clearly if you push back the full fat implementation, but don't push back the SDDT implementation, you remove the need for the ICR. So I don't know to what extent they would seek to create that phased staggering of approach just to make that almost easier. Although, as you say, it does push things even further down the tree. So I think some of the discussions we're having at the moment are the extent to which firms choose or otherwise to engage in SDDT, and the extent to which the capital increases or potential capital increases as a result of it being stronger but simpler are too burdensome. But at the moment, most people still seem to be looking like they're going for it. The other nuances, the extent to which people can need modification by consent or modification by application, because there's a few niggles around some of the eligibility criteria that drop out in the post Basel 3.1 world, which restrict people applying for it at the moment. So yeah, still some interesting discussions on that. And as you said, it's still only a consultation at this stage in terms of SDDT. So the extent to which the PRA does respond on things like the refined approach, which has had quite a material impact for many organisations in terms of bringing some element of competitive equalisation between IRB and standardised firms on real estate portfolios.
Yeah, no, I think that's right. Yeah, no, something else flashed through my mind. It's gone. I know what it was, Ren. Sorry to interrupt. So it's a free option, isn't it? You can signal your interest in the SDDT regime, and you can
opt out in due
play
course.
along with that.
Exactly. Yeah.
And you know, when we've got the finalised rule book, when we do know what the capital add-ons are going to be for small, strong, and simple firms, you can decide to pivot to Basel 3.1, and of course Basel 3.1 credit risk is what is going to be used for calculating the credit risk for SDDT firms. So you're not you'll be ready for Basel 3.1 if you decide to move from the SDDT regime.
Thanks, Stephen and Simon, for your thoughts there. I think, I think largely it could provide a more proportionate framework, but that clarity on application kind of remains key.
It's all down to the capital.
Yeah,
what a firm's going to end up with.
Exactly right. Just wanted to make note of the poll results here that you're seeing on your screen. So the poll went out. How is your firm responding to the PRA's delay of Basel 3.1 to January 2027? We've got overwhelmingly 54% using the extra time to refine systems, processes, and strengthen compliance, which is good. 17% slowing down implementation efforts due to the extended deadline. 23% maintaining the original timeline to avoid any last-minute pressure, and 6% unsure how to adjust strategy. Thank you very much for everyone who participated in that poll. Very interesting to see how everyone is responding there. Stephen, we'll stick with yourself for the next question. So how are banks approaching the new deadline in respect to the way that they're managing the kind of reg change projects associated with Basel 3.1 and allocating resources, etc.?
Thanks, Ronan. To some extent, picking up on the responses that we just got off the poll there. So I suspect the PRA is probably pleased that the vast majority of firms there seem to be keeping with their foot on the pedal going forwards and using that time, you might say, responsibly to perhaps do a better job or a more complete job than they might otherwise have done. I think that's my experience to date, that in most cases firms are pushing forward, but with an eye to we've now got a bit more time to do it better and more completely. I think it does mean some people are bringing resources in-house rather than having to expand the teams, because you haven't got to get as much done in a shorter period of time. So it means you can probably do more with the existing groups of individuals that you've got. So I think it is good that people continue, because we've seen this on some of the other reg change projects, such as stress testing and recovery and resolution, where the PRA has moved from almost a 1 year to a 2 or 3 year cycle. And as soon as you take the pressure off on those, some of that muscle memory gets lost within the organisation when it's not an annual process, and it's actually almost more debilitating than it would be to keep going, provided, as you alluded to earlier, Simon, that we do have an end in sight, and there isn't going to be another handbrake turn or another change in direction in terms of the in terms of the requirements, and that the near final rules become the final rules, just with an extended timeline. Otherwise, I think we get into, we've pushed on further, and then we have another break or another change is going to be disruptive to organisations. Yeah, no, I absolutely agree with Stephen there, and there's an importance of keeping the momentum up. If you don't, you risk losing people. Clearly, as Stephen said, people are skilled people.
a scarce resource in this game, and let's make sure we keep them occupied so they don't sit. If they're sitting back with their feet on the desk for 6 months, they're going to be looking elsewhere, aren't they?
Yeah, absolutely. That's definitely consistent with what we're seeing here. I've had a number of conversations with clients and industry participants, and everyone seems to be thinking that the delay is good. It gives you more time to kind of refine those systems and processes and get all your ducks in a row, as it were. But at the same time, it's not really the time to be taking your foot off the pedal, because as we all know, I mean, this is not the first delay to the implementation, but it does creep up quite quickly, those implementation dates. So definitely something to be aware of. We kind of touched on it there as well, Simon, but I wanted to kind of understand from your side if you think there's any constraints in the labour market in terms of finding PMs, BAs, SMEs to work on Basel 3.1 projects.
Yeah, I mean, there's got to be. I think as we've said, Dominic probably got a better finger on the pulse here, but we need skilled people who've got that familiarity with the way in which Basel 3.1 has developed over the many years, let's face it, who've been involved with thinking about the small domestic deposit takers regime. And, I'm very grateful at UK Finance that so many of you have helped with our responses to those consultation papers. But there are not that many of you around. So I think it's worthwhile firms making sure they hold on to the talent they've got and absolutely are aware of what's out there.
Yeah, and I think from our perspective, Centenaire UK, obviously we've had to prepare for 2 sets of Basel 3.1 implementations in terms of we're also impacted by CRR3 in the EU as well as the UK Basel 3.1 implementation. So I think from our perspective, we've utilised a combination of in-house resources plus also external resources, because we had to run the 2 in parallel to some degree until this point. So we've had to make use of, say, a broad source of resources to enable us to move forward on as it were, both paths that we have to.
I think one area, Ronan, where we have seen some tension is also in some of the bespoke software or tooling that's used for some of the calculation engines in particular areas where, again, there are fewer people in the marketplace who've got that. So the understanding and ability to do Basel and the interpretation pieces and the business requirements and functional specs for that might be, there's more fungibility across organizations, but for some of the specific say calculation tooling and third-party tooling that's used, that could be even more of a challenge.
And that feeds into, Stephen, does it, into sort of further down the road into reporting and so on.
Yes.
And that's, as we know,
without mentioning specific softwares, just for the avoidance of doubt, but yes, the tooling that's used for calculation, reporting, and transmission.
And we know that the PRA is very concerned, I think, about data quality, how firms govern their reporting processes to it. So I think that's certainly worthy of attention. You're right to call it out as a potential stumbling block.
Thanks all very much for your thoughts there. Dominic, I will pass back over to you for this one. Wanted to get your thoughts on how clients are approaching the use of standardized versus IRB approaches.
Okay, thanks. I think one element of the Basel 3.1 rules in the UK is that the PRA have changed the rules on the rollout of IRB portfolios. So that certainly does impact banks' thinking in terms of, if you're already an IRB bank, what portfolios can go to PPU, so permanent partial use, i.e. permanently standardized, versus those which either remain as IRB, or PRA is also mandating for QRRE portfolios that they do become IRB if you're standardized at the moment. So there are some probably more constraints under these rules in terms of if you embark on IRB, what you have to do, than there were under the previous regime. So it's a case of really working through those to understand the kind of, if you're going to commence rollout, what you then need to move on to from the original portfolios. And for banks such as ourselves, which are already IRB, it's working out what are the rules around PPU. So there are certain exposures which it's too difficult or they're insignificant in size to model. The rules around determining those portfolios are now different than they were before. So they have to be navigated through. Obviously, and I think we'll probably touch upon this in a moment about the benefits of IRB. It's always a case of weighing up just the sheer resources, effort, and skills needed to establish a kind of IRB model and maintain it on an ongoing basis versus capital savings and the much simpler and the less need to make all that investment if you remain under the standardised approach.
Dominic, I don't know the answer to this question, but I know you will. But permanent partial use, what proportion of your portfolio, did it used to be 15%? Were you allowed to, if you were an IRB firm, you were permitted to have 15% on standardised? Is that change?
I think it's now 5% of credit risk RWAs, and the PRA also, they've defined rollout classes. So there's some rules about with what certain types of rollout class, and then overall what is the amount of PPU exposure you're allowed. So it's slightly more complex than just like kind of single number where you had to get 90% coverage of your credit risk RWA with IRB. Now you have to cover in some mandated areas like QRRE, and then there's certain rollout classes where you must cover more than 50%. So it's not quite, it imposes many more constraints than the kind of existing CRR2 or CRR based rules that exist today.
Thanks.
Thanks for that. Yeah, I think you kind of touched on it there, Dominic, but the key is just weighing up the capital efficiency of IRB against obviously the more simpler approach in the standardized approach and the gains that you can make from using IRB. So can you expand on that a little bit? So if banks that are approaching the use of models on IRB portfolios, and given those gains, even if they are reduced slightly under Basel 3.1, how are banks approaching that use over the standardized approach?
Well, if we look at IRB versus standardized, I think another point to add here is that for IRB models, there is a benefit under Basel 3.1 in that under current rules, there is a 1.06 scaling factor, calibration factor that's applied to calculate risk-weighted assets. That disappears under Basel 3.1. So there's potentially more efficiency there. Similarly, in the mortgage space, there's currently a 10% portfolio LGD that's applied under CRR. That goes to be a 5% individual asset level LGD floor under Basel 3.1. So that may have different effects and potentially benefits for firms. So it's not a case that Basel 3.1 has made IRB definitely worse. Obviously, there are some parts of IRB where you are better off. Obviously, there are then input floors and some of the output floors which will take away and dial away some of the benefits of IRB. And I think ultimately for banks, a key decision is what is the output floor going to do? In theory, you can still make savings with IRB even with an output floor, but essentially the savings get capped by the level of the output floor. So it's understanding that kind of capped potential saving, which will be very portfolio dependent and model development dependent, versus the kind of cost that you need to establish IRB models in place, both upfront but on an ongoing maintenance basis as well.
And I think that point about the ongoing maintenance, the ongoing governance costs of IRB models is not to be downplayed. I've talked to firms who tell me it's a very significant ongoing cost to support that modelling, and explain it to the board, explain it to the PRA, demonstrate to the PRA you're doing it right.
You can see the challenges at the moment. Back to your earlier question, Ronan, on the approach between standardised and IRB. Those firms who are not yet IRB are continuing to struggle, might be too strong a word, but are facing quite an uphill battle at the moment in terms of getting over the line into into IRB approval. So I think to that second question you had on portfolio mix, to some extent it does depend on which firms you're talking about. So the larger firms, as Dominic said, are now going to be impacted by the output floor at the same time as the IRB changes that were referenced there, which does mean more of a portfolio view to life than they might have done previously. I know the leverage ratio did do some of this, but you've now moved even more towards a sort of portfolio management view required, and you can start to see that with organisations pushing into riskier areas to increase some of the RWA density on the portfolios for those firms who are existing IRB organisations, which then puts even greater pressure on some of the non-IRB or IRB aspirant firms. But those IRB aspirant firms are experiencing the challenges that the existing firms have on things like hybrid in terms of getting their mortgage portfolios over the line, or some of the non-retail books where there's quite some delays in the approval review and reapproval processes with the PRA at the moment.
Yeah, and some of you will know we've actually been working with the PRA. They sort of had something of a change of heart after, again, some nudging from us. So since before Easter, we have been working with the PRA. We've run a series, not a large number, we've run a series of workshops, the purpose of which is to try and identify, what looks like good practice, share some of the learnings, be a lot more open. I think previously firms had linear bilateral discussions with the modelling team at the PRA. We're now trying to share everybody's experience, and that's something that I hope will bear fruit for firms in the future, particularly for those IRB aspirants. Let's not have them make the same mistakes that existing IRB firms have made, because it's been a very torturous process to get to that approval process.
Thanks all. So I think, I guess a way to summarize that is that we might see a mix. Banks will, likely maintain IRB where the benefit is clear, but may start to rethink that where the complexity outweighs the reward, which will be interesting to see. Wanted to move on to discuss the kind of cross-jurisdictional challenges. So we recently held our annual RegTech forum and sat down with Phil Evans, and this was obviously one of the top things on his mind and what was discussed. So wanted to get everyone's thoughts actually on this one. What do you think the specific challenges are that we're going to see for cross-jurisdictional banks?
Well, kicking off, I think you've got the obvious one on timing, because we've now got, as Dominic alluded to, as Santander have got, that they've had to implement for the EU, for the group, which is earlier, and the UK delayed. And if you are one of the other cross-jurisdictional organisations, you're playing in multiple timelines in multiple locations. I think the other point to your comment on the PRA's focus, and you can see this through the recent delays, it's starting to highlight the potential tension between their primary objective around financial stability and their secondary objective around international competitiveness, which is meant to be a secondary, not primary, but you start to see whether the degree to which those are being considered, and also their mantra of sticking closely to Basel and the Basel text, and how that is coming up against this international competitiveness perspective. So it does make it very challenging if you're a non-UK headquartered organisation or a UK headquartered organisation with overseas subsidiaries, in terms of trying to manage that timeline.
Yeah, and I think Stephen's pointed out, we've had to consider both the EU and UK versions of this. I think in terms of implications internally, there's always been a degree of supervisory divergence between the ECB, who regulate the Santander Group, and the PRA, who regulate us at Santander UK. So there's always been some differences, but they're just getting accentuated by the fact that we're now having to calculate risk-weighted assets on a CRR3 or Basel 3.1 basis for the group, and we have getting a greater divergence between the RWAs we would calculate for our exposures for a PRA basis. So then that has implications for things like capital allocation on product lines. It's got implications for pricing decisions, capital-based pricing decisions as well. So we're having to work through all those things now, and it's just been accented or made more significant because of the timing divergence for Basel 3.1 implementation.
Yeah, and I don't think I've got anything particular to add on those two excellent sort of reflections, Ronan. But UK Finance, your favourite trade association, I hope. We've always been very clear that we support international alignment between different jurisdictions' approaches to making Basel 3.1 happen, but particularly in the EU process, which is a tripartite process. There's the Council, there's the Commission, which proposes the legislation, and then, of course, there's Parliament, and Parliament does, the European Parliament does tend to get swayed by particular interest groups from time to time. So I think it'll be interesting to see when the Basel Committee does its RCAP assessment on the UK, on the EU, on other jurisdictions, whether they feel that international alignment is still there. And of course, it may very well be that the United States doesn't think very much of Basel. I don't think that's the case, but that's just the big question mark that we started off the discussion with. What are the United States going to do about this?
There's a couple of other questions coming through on the Q&A exactly that, about if, I think the question is if the US keep pushing back, will the UK push further back, and ultimately could we see it all being scrapped, I suppose, is the taking that to its extreme.
You'd expect the PRA to say this is the final delay.
Yeah, it is, PRA have stated on a number of occasions before that sort of being largely compliant with the Basel standard from RCAP assessment was one of the key aims of what they've been doing. As interesting to see what the Americans do, whether that makes the UK change its approach. I suppose the other aspect to this is that the UK does have the ability to some degree modify capital requirements by playing in the kind of Pillar 2 space and the countercyclical buffer space, and keep the RWAs kind of aligned to Basel, because the kind of countercyclical buffer and Pillar 2 are things where there isn't a Basel guidance, or there's no hard and fast Basel rules to follow, so they could use them to calibrate the overall level of capital whilst being Basel compliant on the pure RWA and leverage calculation elements.
And of course, Dominic, that was the mechanism they were going to use to make sure the withdrawal of the SME supporting factor didn't impact the cost of lending to small firms, essentially. And of course, with the delay of Basel 3.1 for another year, that data collection exercise, which I think was due to be finished, wasn't it, Dominic, by the end of March, has now been put on hold. And I think it'd be interesting to see what firms think. But I think the sooner the PRA can get that started again, the better, given that, as we were saying earlier on, firms will be thinking about their business models, where to allocate capital, which sort of areas they want to ramp up. And until there's a bit more clarity on how the PRA is going to do that Pillar 2A offset, those are unanswerable questions, I think.
I think there was going to be a consultation paper on that Pillar 2A offset mechanism, which was due in Q2. I'm not sure if that's actually been delayed now, but that will be a kind of key part to this, is to understand exactly how the PRA are going to do it, because there's many different ways you could calculate that Pillar 2A offset.
Yes, I think that methodology, Pillar 2 methodology paper is expected in Q2.
Okay.
But again, that's one where they could have pushed forward on the data collection, given it was so close to the completion, rather than deferring that to some extent as well.
Yes, I guess we might see that data collection exercise resuscitated when the Pillar 2A methodology comes out. But I've heard the PRA say, look, some SREP reviews have been delayed because of their expectations about the resource, their limited resource they'd have to devote to the Pillar 2 research. So I think that they'll be using the time wisely then to to catch up with some SREP reviews that are probably overdue.
Thanks all for the comments there. I think another poll was sent out, so we'll just pull up the results of that one here. So biggest challenge for cross-jurisdiction, top of the list there, regulatory divergence, different rules and timelines across the jurisdictions. I think we covered that quite nicely just then. Obviously, there's also operational complexity from a compliance standpoint, the reporting and data requirements across different regions, etc. 18% for capital calculation inconsistencies, variation in RWAs, capital buffers, etc. And 0% for model approval. So there you go. Once again, thanks all for submitting your responses there to that poll. In a similar kind of line, I wanted to also understand from you guys what technical challenges you think we will see in terms of the data and interpretations. I think we covered a little bit of it there, but Dominic, perhaps you want to add some more color to that from a data perspective.
Well, I suppose just thinking of some specific examples here, in terms of needing to use data or collecting data for calculations of Basel 3.1, it's things like transactors kind of come to mind. It's a very different way where you have to look back 12 months to work out what your risk weight is going to be today. So it's a very different thing. So from a data collection point of view, that has to be carefully thought about. And there's some other kinds of complex areas, for example, allocation of collateral, where once again, how you do that, the PRA have kind of put some quite tight restrictions around it. So you need to be sure you're able to collect the data and allocate collateral appropriately. Something a bit more complicated than was there under the existing rules based on CRR as well. So there's just some specific areas where I think there are some technical challenges, from a data as well as to some degree interpretation angle as well.
And I think we've got to remember alongside this, the model risk management policy statement expectations. I think that supervisory teams will become more interested in how firms are making sure they're assessing themselves against those model risk management expectations that were released now, 18 months, 2 years ago. That's some work that can't be forgotten.
And we've seen on some of the other data issues, picking on Dominic's thing, things like the real estate valuations, materially dependent, some of the insurance aspects, where firms may make what are considered as pragmatic or practical assumptions and judgments. And we've seen in the past, particularly in the context of my old favourite SME support factor, where what is perceived to be something that should provide a benefit and to encourage lending in a particular area, if you make it so hard and so onerous to prove that the exposure you've got in that, and therefore not allow people to make their decisioning based on reasonable assumptions and judgments, which has been the approach so far to date in that area, becomes a bit of a challenge. So as Dominic said, there's some quite specific areas that need to be thought through, which the additional time with the delay probably helps flush those out, and for those firms who started later in the journey.
Thanks, Stephen, and thank you, Dominic and Simon there as well. Wanted to just touch on briefly from looking at it instead from a strategic or commercial perspective now. How are banks kind of looking at the impacts now that we've got this implementation? The deadline has been extended.
I think it's the largest banks will have been looking at this for some little while, Ronan. So I suspect they'll be just sort of course correcting in the light of various changes. I mean, I suspect most firms will have welcomed the additional delay, but it may be that some firms did actually see a capital reduction, and they will have perhaps be disappointed that they won't be able to reap that capital reduction for another year. But I think firms have been thinking about this for some little while now.
Yeah, I think from sorry, Stephen, go ahead.
No, after you.
Okay. Well, I think from a strategic planning angle, I think, at least personally, I'm still assuming we're going to end up with something very similar to the current proposed rules applying in the UK. So I think thinking longer term, it's maybe a year delayed in terms of implementation, but if you're looking for longer term decisions, you're going to be on something similar to the regime that's proposed in PS 924. So we're kind of very much thinking along those lines from a longer term view. We're ultimately going to be here, so let's start planning ahead based off that final outcome.
And just to pick up on or reiterate the point I was saying earlier, that because the output floor is now shaping some of those strategic decisions, and so you can see that in terms of the portfolio mix and the portfolio quality as people try and aim for almost an efficient frontier of assets that look okay on both a standardized and an IRB basis. You don't want your portfolio to be too good, too skewed one way or the other. We're also seeing a pickup in people looking at more structural mitigations as a response where they can't get that portfolio shape organically. So through securitization SRT and synthetic SRT approaches to try and shape the portfolio in the way that they want. And you're seeing that across larger and smaller firms actually trying to pick up some of that work.
Just a point of information. I was thinking about this the other day, Stephen. My sort of common understanding is that firms use securitization to access less expensive funding costs. The hoops a firm has to go through to get strategic risk, significant risk transfer are pretty significant, aren't they? Are SRT trades being done now, do you think? Or maybe
yes,
they've always been being done and I just haven't clocked it.
Yeah, no, they are, and for different reasons as well. So as you say, I think there was a time, if you go back in time, it was for capital purposes, then it became more for liquidity and funding purposes, and you're now starting to see much more, as I was just referencing there, working with firms both large and small on those trades more now from a capital perspective. And yes, there are hoops and processes and operational aspects that need to be taken into account, but there is work being done in that, and we're seeing considerable sort of focus on that, both actually not all in the UK, also quite a lot of work overseas as well from organisations picking that up, but more from a capital perspective than necessarily a funding perspective as well.
Thanks.
And I think it's just worth adding that the PRA have been looking really with the output floor in mind at what's called the SEC-SA approach, which is one of the ways you capitalise retained tranches on SRT securitisations. And so I think they've been conscious that there's maybe going to be too many penalties under the output floor for securitization. So there is some accommodation by the PRA in terms of securitization for the output floor, which I think makes it more attractive for the kind of activities Stephen was talking about. It's trying to rebalance your RWA exposure to get it in areas where you can avoid sort of really painful impacts on the output floor.
Lovely. Thank you all very much for your comments there. We have a few questions that have come through on the Q&A, so I thought we might jump to those. Simon, there's one that's directed specifically at you. I think maybe we've touched on it already, but given the continued lack of clarity coming out of the US, does it remain possible that PRA and Treasury look to delay beyond 2027? Is there a point where the delays become unhelpful to banks? Should the PRA and Treasury start thinking about splitting FRTB from the package as a contingency measure?
I think they'll be disinclined to split FRTB from the rest of the package. I think the clear messages I've got are, look, this is the final delay. There have been a number of delays over the recent years. And I think there's a sense that probably the Fed has got something on the stocks from, was it the summer before last, which could be modified to the extent it's modified. I think maybe there's some US firms on the call, but I think if you're a GSI, a GSIB, you'll be wanting to get on with this. I think the area of debate in the US is going to be those, not the top 30-ish banks. It's going to be how Basel 3.1 applies to those banks that are super regional, but smaller than the top 30. So I think the US will do something close to Basel 3.1. It's a question of how it's applied more deeply into the banking system. What happens in the EU? Are they going to delay FRTB for another time? I think they well might. It's clear that not all countries in Europe, well, not all banks in Europe, want to see a delay of the FRTB. Some are very much in favour of it. Others think, well, we're doing Basel 3.1. Let's crack on with it. But I suspect we'll see an announcement from the EU authorities of a further delay to the FRTB over the next few weeks, even.
Thanks, Simon. I'm just looking at the rest of the Q&A questions here. Majority of them are to do with further delays or the divergence questions there as well. So it looks like we've covered most of them. There is one a question here around when we can expect the final policy statement for Basel 3.1, and if you think that there will be a much degree of change in that compared to the final policy statement. Simon,
I don't think there'll be very much change, if any. De minimis. No doubt there are typos and things which will be corrected, but I think what we saw in whenever it was mid-September is what you're going to get when we get the final policy statement. And I'm very much encouraging the PRA and Treasury to release that final policy statement quick.
And on the final question you've got here about the link between the large exposures and the 3.1, then it does make sense for that to be aligned, given there are quite a lot of linkages and references between the two, between those proposals, so that you don't get out of sync. So in that regard, I think aligning those, but as Simon says, pushing for the 3.1 as quickly as possible. I mean, no further delays would be helpful, but making sure that the large exposures, you don't change once for that and then change once again when it brings back in line with 3.1 would make sense for firms. And I think it's broadly in line with the proposals that you've responded back on, Simon, I think, from a UK
Yes, that's right. And
this
idea of sort of grandfathering or rolling over in a soft way existing large exposures permissions to align with the start of Basel 3.1 in the UK. Yeah.
Great. Well, thanks very much for that, and thank you for those Q&A questions that have been submitted. I just want to say a big thank you to our panelists, Simon, Stephen, and Dominic, for sharing your expertise and insights today. Your perspectives on the latest updates to Basel 3.1 have been incredibly valuable. And to everyone who's dialed in, thank you for joining us today and for your engagement and thoughtful questions. We hope that you found the session informative and got a lot out of it. A reminder, we are offering some free 30-minute consultations, so please do follow the instructions on screen if you are interested in those. And once again, a big thank you to our panelists and to all for joining us today. And we look forward to seeing you at the next session. Thank you. Thanks, Simon. Thanks, Dominic. Thank you, Stephen.